Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We have a great show for you today. We're going to talk a lot about not only the investment markets here and around the world, but also the U.S. economy and the emerging market economies. If you have any questions about your portfolio, of course, we will be taking your calls today. The number will be at the bottom of the screen. You can also send me an email question that I can read and answer on the show at brianresny@reznywealth.com. We always enjoy your questions. And again, make sure that you call quickly because our phone lines usually do get packed. And again, you can send us an email at brianresny@reznywealth.com. You know, it's interesting. We look at the U.S. economy as we obviously are headed into the second quarter of 2014. And generally speaking, earnings season is starting to blossom. We're already seeing some pretty good indications that corporations are obviously making more money. A question I often get from my TV and my radio listeners is, Brian, why is the stock market going up for no reason? The bottom line is this: the stock market's going up primarily in the U.S. because earnings are growing. If earnings grow, typically asset prices or stock prices follow on that uptrend. So while you can listen to a lot of negativity and while there's a lot of talking heads out there that will give you opinions and be emotional, and investors tend to make emotional decisions with their portfolios, I'm here to tell you this. If you follow a strict investment strategy, which includes risk management, you have a good chance to grow your portfolio and protect against major catastrophic downward falls in asset values and assets in your portfolio. With the economy slowly getting better, again, I firmly believe interest rates will slowly tick up over time, which is going to hurt bond investors. But if the economy continues to expand slowly, which we are seeing, we have a good potential for earnings to grow, which is a catalyst for equity prices to continue to rise. Are we headed for a major correction? This is a question that has come repeatedly to my TV and radio show, and at the end of the day, I'm going to tell you this. Market corrections often happen anywhere from 20% on up. That's a real market correction. What this basically means is if you owned a stock or let's say an index, the S&P 500, and it dropped at least 20%, that's usually a major market correction. If we look at the last two recessions, we saw between 35 and 50% drops over the last two recessions. Now, I'm not looking for any kind of correction like that. In fact, we don't go into recession unless the economy is slowing. So while corrections are normal, the bottom line is this: we're not looking for major downward drafts in equity prices. You need to know when to sell is a big thing that I try to teach all of our investors. When to sell is an important aspect of portfolio management. The problem most investors face is they don't know when to sell because they actually didn't know when to buy or what to buy. So let's talk about that. Emotions and a lack of investment strategy, which includes risk management, is detrimental to your portfolio. Too many investors base decisions on emotions or knee-jerk reactions. As an example, we've seen these little bouts of downward pressure or sell pressure in the equity markets. Typically, you're going to see 2 to 5% movements up and down in the equity markets, and almost all investment asset categories at least a dozen times a year. So what that means is the markets or any investment doesn't go straight up. It kind of does this. And you're going to see these little bouts of 2 and 5% movements. That's not a market correction. That's normal volatility in a monthly, quarterly scenario with any asset category. By the way, the investment markets are not just the stock market. In fact, if I look at last year alone, treasuries, long-term treasuries dropped about 15% and have yet to regain that big loss from last year. Now that obviously is a risk asset, but most people think bonds are safe. And I'm here to tell you, bonds can be as risky and as volatile as the equity markets from time to time. I find 90% of investors, 90%, falsely believe their broker is actually watching and managing their money. This is simply a big mistake. Brokerage firms And again, these are all the big Wall Street firms and the small brokerage firms and broker dealers. You know, these firms that run these warm and fuzzy commercials, we're your trusted advisor, or don't outlive your retirement. The bottom line is this. Most of these firms give you a sales pitch. If you are in a brokerage account, you're not in a managed account. So don't expect your broker, who uses a fancy title of advisor, to call you and tell you when to sell. That's not going to happen. You're going to ride it up and you're going to ride it down, often more than you rode it up, as investors that worked with these firms saw in 2000 and in 2008. I'm here to tell you we're not seeing any signs of a recession currently. Of course, that will change over time. What I am going to tell you is this. Don't expect a call from Mr. Broker the next time we're in a recession and your portfolio drops 30 to 50%. Your broker doesn't manage your money, and they're not responsible to manage your money. Unless you're in an investment advisory account, which would be managed money, do not expect a call from Mr. Broker. Your broker, so-called advisor, is not managing your money, and I want to stress this so much. I get so many calls on my shows from investors that say, my guy never called me. He never told me to sell. They're not going to call and tell you when to sell because, again, in a brokerage account, that's not managed money, although people believe their broker is actually watching, and some by miracle, they're going to call you that you need to sell. Don't plan on it. What is your investment strategy? The question I have for every investor is simple. Do you, in fact, have an investment strategy, and are you following that investment strategy, which includes when to buy, and more importantly, when do you sell investments that you've accumulated, when it's appropriate to sell before those assets go in the wrong direction? Too many investors buy investments and they don't have a sell discipline because, again, they're falsely believing that their broker, their Wall Street firm, is going to call them and tell them when they should sell. The only time you're going to get a call from Mr. Broker is when he wants to sell you a new investment to generate another commission. Buy high and sell low is very typical for the investor. A recent Delbar study, which Delbar basically looks at investor emotional investing strategies, and they looked at the last 30 years. In fact, Delbar's done this study for over 30 years. And what they find is the average investor underperforms the investment sectors by a country mile, often half of the return. The reason? They buy high and they sell low because, again, you don't have an investment strategy which indicates when to sell. You're basically haphazardly buying investments. That's detrimental to your portfolio. William in Fort Myers, Florida. I'm 68 years old. The firm I'm working with suggested I liquidate my variable annuity for a security benefit equity index annuity. My advisor says it has a better chance to grow. What do you think? I think your advisor is an annuity salesperson, William, is the bottom line. Your advisor, William, is not an advisor at all. He's an annuity salesperson who wants to sell you what's called a toxic annuity. Do not buy an equity index annuity from Security Benefit or any of these firms. I do not like annuities in general because they have high cost. They have high internal annual expense ratios. They have huge surrender penalties that hold your money hostage in order to get all of your money out. The returns on these things are going to be lackluster at best. What this person's doing is he's taking you out of one annuity to reload you on another commission in this product. Don't do it. That product you're talking about has surrender penalties as long as 10 years. Most of these equity index annuities, I've reviewed not only their income riders and their expense ratio. These things should not ever be allowed to be sold to investors, but unfortunately the insurance industry is so loosely regulated, people that have a simple insurance license can basically bamboozle you, sell you unfair, and sell you one of these expensive annuities. Don't buy that annuity. In fact, you're not working with a fee-only fiduciary at all. I would suggest you call my office. Let's talk. We can review that variable annuity and see if you, in fact, should get rid of it. But better yet, make sure you have an investment strategy and you're getting proper investment advice. Don't be sold an annuity, and I would suggest you go to my website ReznyWealth.com. Download for free Why Annuities Are Dangerous to Your Wealth and Your Retirement. Once you read that report, you'll realize why annuities should be avoided at all cost. Dennis in West Palm Beach, Florida. Brian, do you believe in using leveraged ETFs for your portfolio? Dennis, no, I do not, under most circumstances. At Rezny Wealth Management, we tend to be a more conservative investment firm. An ETF is an exchange-traded fund for those of you who don't understand. There's many of these ETFs that actually leverage. What that means is you can buy an ETF that, let's say, buys the S&P 500, and you could buy the SPY as an example, and it basically mimics the S&P 500. So if the S&P 500 goes up 2%, that ETF will go up 2%. If you buy a leveraged ETF, and there's many of these out there that are 2 times, 3 times, and even 4 times leveraged, what that would mean is if the S&P went up 2%, you could actually go up 4% on a 2-time leverage. The problem with this is I see people lose a lot more money than they're going to make. If you start leveraging and taking on more risk, when you head into a market correction, if we do get one, you're going to lose a fortune. So, Dennis, I would suggest you do not use leveraged ETFs. If you are going to use one, a way that you might consider is a hedge only. As an example, if let's say 100% of your money is in the equity market, and you want to hedge against a market correction, you might sell 20% of your portfolio of equities, buy, let's say, 20% of an ETF that is double leveraged inverse in order to protect about 80% of your portfolio. So there is some use to leverage, but don't over leverage, meaning don't own more than 100% of your portfolio in any one direction, because that risk can come against you. And I've seen a lot of investors hurt by using inverse ETFs, either leveraged or long ETF leveraged, because they didn't understand how they really worked and the risk they were taking. Tom in Bonita Springs, Florida. I have 3 high-yield bond funds, approximately 70% of my portfolio. I need income. What do you think? Tom, great question. I'm seeing a lot of investors stretching for yield because investments they once owned are not providing the income they need. Let me tell you the problem I have with you owning 70% in high-yield bond funds or high-yield bonds in general. First off, I don't know if you knew this, but high-yield bonds and high-yield bond funds are almost 100% correlated to the stock market. Meaning if the stock market goes up, those high-yield bonds have a chance to go up. But on the other side, if the bond or the stock market goes down, high-yield bonds often drop as much or more in a recession as the stock market. So what that tells me is you've got a lot of money in high-risk assets. By the way, we are at the lowest yields in high-yield bonds right now. This is the exact time that I would want to avoid owning any high-yield bonds or bond funds. Let me tell you why. Because when you maybe have bought those bond funds, if you did buy them 5 years ago coming out of the recession, those values went up like the equity market. The problem is because high-yield bond valuations are so stretched, the yield is so compressed and low, you're actually getting a low yield with almost no upside at this point in time on high yield. It's not like buying them at the bottom. You own these at the top. I would substantially reduce your exposure in high-yield bond funds, and I would not own any high-yield bond funds at all, because you basically have none of the upside at this valuation metric of the markets, but you have all the risk and more potentially if the markets go down in high-yield bonds. Lynn in Marco Island, Florida. What do you think about investing in the oil sector? Lynn, great question. The oil sector in general, and by the way, you can look at ETFs or exchange-traded funds that invest primarily in the oil service sector or the big integrated oil companies like your Exxons and Mobils and things of that nature. I believe the place where there's the better opportunity, Lynn, is in the oil service sector. That has the bigger margins, the bigger chance to grow as there's more oil exploration like we're seeing out west with oil fracking. And by using an ETF that owns multiple stocks in the oil service sector, you're diversifying your portfolio instead of you trying to pick 5 or 6 individual stocks that may be appropriate. I like the oil service sector. It's in a positive short-term, intermediate, and long-term trend. And in our ranking system on relative strength, it's actually towards the top, so that's positive. Again, you're going to have some volatility with the oil service sector. It's not going to be a straight-up shot, but I firmly believe there's great opportunity for you, the investor, in the oil service sector if you want to place some of your money in that one particular sector. But use ETFs in the oil service sector so you're properly diversified and all your eggs are not on one side of the basket or the other. I'm going to take a short break. Again, our number's at the bottom of the screen. Please visit my website, ReznyWealth.com. You can go to my website. You can sign up for our weekly blog newsletter. You can also download any of our free reports. Why annuities are dangerous to your wealth at retirement, how to avoid outliving your money during retirement, and my #1 report, Fiduciary versus Suitability. Your biggest risk as an investor is to falsely believe your broker is actually working in your best interest and also managing your money. Read that report. I'll be right back after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Every single week I receive dozens of phone calls on my TV and radio show from disgruntled investors who were sold an annuity that didn't belong in their portfolio. Don't let your retirement be taken to the woodshed. Read my free report, Why Annuities Are Dangerous to Your Wealth and Retirement. Go to ReznyWealth.com right now. And we're back. We've got a great show. Of course, we're taking a lot of questions, and of course, giving you great answers to any of your investment questions. Our number's at the bottom of the screen. You can call with your question. And of course, if you'd like, you can send me an email question to brianrezny@ReznyWealth.com. And of course, visit my website, ReznyWealth.com. I know we always get a lot of calls and questions about our free reports. They're available on our website. And as always, if you're concerned about the advice you're currently receiving, maybe you're retiring, maybe you're already retired, maybe you just inherited money, or you're just realizing the firm you're utilizing isn't doing the right job with your money, call my firm for a consultation. There is a difference, and I invite you to experience it. Watson in Miami, Florida. I'm 34 years old, and I have $41,000 in my 401k plan. Where do you think that money should be invested? Watson, I don't know your risk profile, of course, but if I look at purely your age of 41 and you're going to retire, let's say at age 65, you've got obviously about a 24-year time frame before you're actually going to retire. That's a long time. I would primarily look at small and mid-cap equity-based mutual funds within your 401k plan. Most 401k plans have very limited access to different investments. But look at your plan. Most have 12 to 15 options within most 401k plans. Look at small and mid cap, and you could even look at large cap. But really the kicker, generally speaking, longer term has been the small and mid cap market space, especially for a younger investor like you who can handle some short-term volatility, but you're ultimately trying to grow your money long term. I would do a 50-50 allocation to small and mid cap. If you want to be a little more conservative, you could do, let's say, a 40% allocation, small 40 on the mid and 20 on the large. Phil in Naples, Florida. Market is at all-time high. Is it a good time to sell? Phil in Naples, let me tell you what. If I had $1 for every time I received that comment that the market's at a high, should we sell? How do you know the market's not going higher? Your comment about the market being high, by the way, has been spot on, and that would have been the right comment anytime the last 100 years of the investment markets if you looked at any 5-year time frame. The markets have successively gone up to new highs over the last 100 years. Is that a guarantee that the markets will continue to go higher? No, But at the end of the day, if corporate earnings expand, you have the opportunity for equity markets to go higher. So just because the market's high doesn't mean the market's magically going to drop 5 or 10 or 15%. It could happen, but at the end of the day, the U.S. economy is getting stronger, corporate earnings are growing, unemployment's going down. This bodes well for corporations making profit, which often bodes well for increasing equity or stock prices. So I would not just randomly sell. What it sounds to me like, you don't have an investment strategy, which includes when to sell or a sell trigger. I would suggest call our firm for a consultation. We run a strict investment strategy which helps you gain upside potential, and we also protect against downside risk because we have a detailed investment strategy which we follow, which includes risk management or when to sell. Give our office a call. The number's at the bottom of the screen. Larry in Coral Gables, Florida. I read your annuity report, why annuities are dangerous to your wealth and retirement. I was sold 4 variable annuities, 2 from Nationwide and 2 from Prudential. All have greatly underperformed. What would you do? Larry, great question. I could tell you, I've been managing money for 28 years. Over half of the people that come into our offices that interview us to manage their money have been sold 1 to 4 annuities. I am yet to find an investor who wasn't disgruntled after they purchased these products. Annuities are toxic. They're expensive. Those expenses drag down your returns. You have limited to mediocre investments. And you pay higher taxes than you were led to believe. The bottom line is this. You can get out of any annuity you want. There may be a surrender penalty. What we always like to do is weigh the annuity itself, how long the surrender penalty is, what cost savings can you save in reducing the expenses by having a professionally managed account, and what's the break even. If you figure those numbers out, you might find that by getting rid of the annuity, even with a 2 or 3% surrender penalty, your break even might be less than a year. Then you might want to consider getting out of those. At the end of the day, the longer you keep an annuity that has excessive internal expenses, by the way, almost all these annuities, so don't think yours is any different, listeners, all these annuities, generally speaking, have tremendously high expenses that rob your return. So the sooner you get rid of a high expense annuity for a low cost portfolio, the more money that goes back into your portfolio in return, because less money is going out paying Mr. Broker, insurance company, and Wall Street, those hidden cost fees that rob your return every year. I'd also suggest, if you haven't read my report, Why Annuities Are Dangerous to Your Wealth and Retirement, go to my website. You can download it for free. Ed in Naples, Florida. We are working with a large brokerage firm. The majority of our money is in bonds, munis, and corporates. We invested 3 years ago, haven't done well. We heard you talk about markup and markdowns on bonds. How do we know advisory versus brokerage? Ed, great question. Most investors that come into our office, in fact, over 90% are in a brokerage account and falsely believe their broker was actually working in their best interest, which they don't, and also is managing money, which they don't. If you're in a brokerage account, you're under suitability. If you're in a brokerage account, that's not managed money. That's not an advisory account. Markups and markdowns happen with all these brokerage firms. This is where they don't have to disclose how much they're marking up the bond that they sell to you. You could buy a $100,000 bond that the brokerage firm paid $95,000 for. They mark it up 5%, which robs, again, your return. Brokerage firms mark up markdowns. They have a lot of hidden cost and agenda. At the end of the day, conflicts of interest are going to work against you and your money. And when you're working with a commission-based or even a fee-based firm, those hidden costs may be part of the equation. So what you want to find out is the firm you're working with, are they fee-only, which is the only kind of firm you should work with. If you want to know more about fee-only and fiduciary and suitability, go to my website, ReznyWealth.com. Download for free our fiduciary versus suitability report. It'll tell you exactly the difference between commission, fee-based, and fee-only. The only way to go is a fee-only firm so you can avoid the high cost and the conflicts of Wall Street, insurance companies, banks, and insurance salespeople. Michael in Miami, Florida. Are financial advisors independent, or are they required to sell specific products, their firms, from their investment firms? Michael, great question. Most investment advisors, or I should say most advisors who use a fancy title like vice president, wealth manager, financial consultant, most of these people are actually work for a firm and are required, yes, required to sell the products that that firm sponsors, manufactures, and sells. So there's no objective advice. There's a lot of high cost and high conflicts against junior money. When you're working under against suitability, which is not fiduciary, that firm can actually show you products that are actually low performing, bad performing, and high expenses, and suitability's been met. At the end of the day, you as an investor need to understand where the advice you're getting is coming from. Is it sales, like under suitability, or is it fiduciary standard, which is what you want to work under? Go to my website again, ReznyWealth.com. You can download for free that fiduciary versus suitability questionnaire and find out more. Is your portfolio being taken to the woodshed? Is it being managed? And what are the real costs of the firm you are utilizing? If your goal is to have a successful retirement, and you want to reduce investment stress so you can spend more quality time enjoying your retirement, call my firm for a consultation. The number's at the bottom of the screen. I always stress, it doesn't hurt to talk and get a second opinion. As I always say, our clients just enjoy retirement. If you're realizing you've got a lot of stress in your portfolio, if your money's actually not being managed properly, if you're realizing somebody sold you a bunch of annuities, or you're working with a Wall Street firm or a bank or an insurance agent who's not working in your legal best interest and actually managing your money, give our office a call. We would love to have you as a client of our firm. We can sit down, review your portfolio, look at what's really going on, see if changes need to be made. More importantly, we provide active money management, which includes risk management. So while an investment strategy is important, the thing that I try to educate all of our clients, our TV and radio listeners, is simple. There is a difference, and we invite you to experience it. At Rezny Wealth Management, we're a fee-only money management firm providing exactly what you need. Timely management of your assets, risk management in severe down markets so you can have a successful retirement. Again, call my firm for a consultation. Please visit my website, ReznyWealth.com. That's ReznyWealth.com. Download any of our free reports. You can also go there to sign up for a consultation. Make sure you have yourself a safe and profitable day. Hello. Rezny, president of Rezny Wealth Management, a fee-only registered investment advisory firm. We have a special report just for you pre-retirees and retirees, how to avoid outliving your money during retirement. We cover the major pitfalls many smart investors overlook and leave money on the table. Go to my website, ReznyWealth.com, and get your free report.